All right, let's jump right in. Today, we're going to talk about a chart pattern that, well, it kind of looks like a megaphone shouting about a stock's next big move. It's called the ascending broadening wedge, and believe me, it's one of the more powerful but also kind of tricky signals in the market. Get this one right, though, and you can spot major trend reversals before pretty much everyone else. And here it is. Take a look. You see those two trend lines? They're both pointing up, right? But here's the key. The top line is steeper. It's rising faster than the bottom one, and that's what causes them to spread apart over time. It seriously looks like a megaphone tilted up, which is exactly where it gets that nickname. So the big question is, what is this thing actually telling us? You've got this expanding, upward-moving battle between the buyers and sellers. It's a story of growing excitement, for sure, but it almost always has a dramatic plot twist at the end. So what happens? Where's it headed? To figure that out, here's how we're going to break it down. First, we'll get into the psychology behind the megaphone. Then, we'll put on our detective hats and learn how to spot a real one. After that, we'll look at the cold hard numbers, what usually happens when the pattern breaks. And finally, we'll see how real traders actually put all this into practice. Okay, section 1. It's one thing to just see the pattern, but to really get it, you have to understand the human behavior behind it. The greed and the fear that actually carve out this very unique shape on a chart. So let's get the official definition down. It's really just a pattern where prices are bouncing between two trend lines that are both sloping up. The critical part, the thing you have to remember, is that the upper line is steeper than the lower one. It's this constant expansion, this widening gap that creates all the tension. The story behind this pattern is pretty fascinating, because it's really all about people. It usually starts with what traders call smart money. We're talking big institutional investors, maybe hedge funds. They start buying up shares, kind of quietly, but their demand is enough to get the price moving up. That's the first push. Of course, secrets don't last very long on Wall Street, right? So pretty soon, momentum traders, these are the folks who love to jump on stocks that are already rising, they see the action and they pile in. This new wave of buying just sends the stock flying up to a new higher high. And bam, that's the first peak of our megaphone. Now, this is where the real fight starts. At that new peak, you've got value investors who are thinking, whoa, this stock is way too expensive, so they start to sell. But the price doesn't crash. Why? Because the buy-the-dip crowd rushes in, thinking they're getting a deal. This constant push and pull, this clash between wild enthusiasm creating higher highs and strategic buying creating higher lows, that is what carves out that broadening megaphone shape. But, this can't go on forever. Eventually, the stock just gets too pricey. The big money that kicked the whole thing off decides it's time to cash out and take their profits. The buying pressure starts to dry up, and you can almost feel the smart money quietly tiptoeing toward the exits. The stage is now set for the pattern's climax. Okay, on to section 2. So we know the story behind the pattern, but how do we spot a real one out in the wild? How do we not get faked out by something that just looks like it? Well, it all comes down to a pretty simple detective's checklist. Here are the rules for our pattern detectives. First, just confirm the basic shape. Two lines, both sloping up, getting wider apart. Got it? Second, and this one is an absolute must, you need at least 3 distinct price touches on each trend line. Not 1, not 2, 3 touches on the top line and 3 on the bottom. That's what validates it. And third, you're on the hunt for a very specific clue called a partial rise. This slide is a perfect reality check. Spotting these things isn't always neat and tidy. Look closely at this chart. You can see right there where the price just briefly dipped below the bottom trend line. That's what we call a false breakout. A beginner might panic and sell there. But look, the price recovered. This actually forced the analyst to redraw the bottom line to fit the new price action. It's a great reminder that you've got to be flexible. Now let's zoom in on that partial rise I mentioned, because this is such a critical clue. A partial rise is what happens when the price bounces off that bottom support line and starts to climb, but it just runs out of gas. It fails to make it all the way back to the top trend line. This failure is a huge red flag. It's the market basically whispering that the buyers are getting tired and the upward momentum is dying out. Let's just compare these two side by side. On the left, that's a textbook partial rise. See how the price tries to climb, but just can't reach the top line before it rolls over and breaks down? Now, look at the chart on the right. In this case, the momentum stayed strong. The price kept hitting that upper boundary again and again, and what happened? It eventually broke out to the upside. So the presence or absence of that partial rise is an incredibly powerful tell. So we know what it is, we know how to find it. Let's move to section 3. What actually happens when this megaphone pattern finally breaks? This isn't about gut feelings, this is about probabilities. And lucky for us, the historical data gives us some really strong clues. And here it is. This is probably the single most important statistic about this entire pattern. Even with all those higher highs and higher lows, the ascending broadening wedge is overwhelmingly bearish. Research shows that it breaks downwards 73% of the time. Think about that. That means roughly 3 out of every 4 of these patterns end with the price falling. So what happens after the break? Well, in a bull market, the moves can be pretty massive. When it beats the odds and breaks upward, the average rise is a huge 38%. But even when it does what it usually does and breaks downward, the average drop is still a very substantial 17%. So either way, this pattern is screaming that a big move is on the horizon. And remember that partial rise clue we just talked about? Well, here's the data that proves how important it is. In a bull market, when you spot a partial rise, it correctly predicts a downward breakout 74% of the time. That is an incredibly reliable signal for this specific pattern. But before you get too excited and run off to trade this, here is a crucial piece of advice from the source material. Even with probabilities this high, nothing, and I mean nothing, is ever guaranteed in the market. You have to wait for a confirmed breakout. It pays to be patient. And that brings us to our final section, putting it all together. How does a trader actually take all this knowledge and use it in the real world? Let's walk through a real-life example. First things first, you need a target. The measure rule for this pattern is just beautifully simple. For a downward breakout, your minimum price target is the lowest price that was hit inside the wedge. That's it. It's an easy-to-find, data-driven target for your trade. Now for a great story. This is about a guy named Curtis, a night shift worker who was tracking a stock in his spare time. He spotted our ascending broadening wedge, but he also saw something else, a double top pattern. Now that's when a price hits a high point twice, but can't break through. Putting those two bearish signals together was a massive red flag for him, and he knew he had a potential opportunity on his hands. So here's exactly how he played it. He followed the rules perfectly. He waited patiently for the price to actually close below that lower trend line. He wanted confirmation. Then he sold the stock short at $39.50. He set his price target based on his analysis, and he just held on, even through some ups and downs. And his patience paid off big time when the stock hit his target, netting him a really nice profit of about $12 a share. So you see, the ascending broadening wedge isn't just some random shape on a chart. It's a story. It's a narrative of market excitement hitting a fever pitch right before a dramatic turn. It's a battle between pure enthusiasm and total exhaustion. And now that you know how to read the signs and decode its message, the only question left is, what stories are you going to see unfolding in the charts?